Alright guys, so in today's video we're going to be backtesting what's called the Asian liquidity model. Essentially what it relies on is mapping out the Asian session range, waiting for one part of the range to be taken out and seeing if we can trade to the opposite side of the range. So let's get straight into it. Let me just get a new chart here so we can see things a bit more clearly. And let's start from yesterday, right? So currently today it's the 12th of March 2024. Let's start from the London session from yesterday and let's just see what price action did. We're on the 1 minute chart, right? And we'll see what happened yesterday, right? So what we're going to do is we're going to map out the Asian session. Now, I class the Asian session as 7 p.m. till 12 a.m. and that's New York time. I know some people, go 6 to 12, other people go 8 to 12. I go 7 to 12. That's just what I've heard from ICT, and that's kind of what I'm going to stick with. So 7 to 12, there's a couple ways to do this. You can either do some vertical lines, and you can go from, 7 o'clock roughly here, and then you can go 12 o'clock here. And then what you do, or what I like to do sometimes, to make it nice, in terms of a diagram, you can get like a text, like a rectangle text here, text box. And all you do is just make like a little bit of a box here. You map that out. That there is your Asian session range, right? Now what I do is I map out the highest point and the lowest point in that range. So this here is roughly the lowest point, give or take. Now notice here there's a swing low very, very close. I'm going to include that because they're relatively equal low. So I'm going to map that out, right? Then I look at the exit of the Asian session range. And notice in this case, like right on 12 o'clock, I think it is, right on 12 o'clock, we actually take out that Asian liquidity. So in this case, we do actually follow the model because we take out that Asian session range and watch what happens after we take that out. Do we come to the extreme of this Asian session range at the top here? No. But do we take out some Asian session buy side liquidity? Yes. So that is Asian buy side liquidity, and that is Asian buy side liquidity there. These are relatively equal highs. So when you're looking at the markets and you're using this model, you're looking for either one of the buy side or sell side targets to be taken out. In this case, we take out the sell side target here, we raid that. And then pretty much for the rest of the session, leading into like the silver bullet, and the end of the silver bullet, we've got bullish PD arrays being respected. So this here is your bullish fair value gap. So you can see that. Bullish fair value gap. And then you've got another fair value gap here too. And essentially all we keep doing is respecting all these bullish PD arrays. We accumulate in the gap, we push up, we accumulate, we push up. And then we push all the way up to take out these levels of buy side liquidity. So when you're trading the markets and you're using this model, you don't even need to take out this buy side liquidity because depending on where you're entering from, and again, I'm just going to map all these things out here. You've got a bullish gap right there. You've got these two candles, which is an order block, right? Depending on where you're entering from, guys, you don't need to take advantage of everything. Like you could enter from here, stop below the order block and that candle and target those eagle highs, or you could just target these highs depending on what your risk to reward wants to be, right? So that there's the Asian session model. Now you might be curious as to why we don't take out this swing high. Well, the reason why is because of this: 1 drive, 2 drives, 3 drives. That there's the 3 drives pattern, and I might just write that out here. So that's the first drive, that there's the second drive, and here is the third drive. Right, so it's a 3 drives pattern, and then notice we come down, we actually raid some internal liquidity, and then we sell off again. Right, we sell off. We end up taking out these lows again, and then we push back up again, but we don't take out this high still. Right, it still remains intact. So that there was, yesterday's session with the Asian session model. Let's just go back, obviously, because that's Monday. Let's go back to Friday's session and see how many times in the last week we actually respected this model. So let's have a bit of a look. Let's go back. This here is Friday, and let's do the same kind of thing. Let's map out the Asian session range. So let's grab a box. Let's look at where roughly 7 o'clock is, and then let's go to 12 o'clock, which is roughly maybe here, and we'll find the highest point and we'll find the lowest point, right? Now in this case, what you can see, have a bit of a look, that's your Asian session range. But notice when we actually enter 2 o'clock, which is when we start trading the London open session, we don't actually purge any of these highs. And notice, like, if I just grab my Fibonacci from this low to this high, right, then I get the halfway point out. We'll just get rid of these, we don't need these. And we get the halfway point out here. Notice how at 2 o'clock roughly, we're just sitting roughly at the halfway point. So we're in between the Asian range. This is where, instead of taking out liquidity, we're trading towards liquidity. So in this case, the liquidity kind of rests above, you can see, and that's how we trade first. Do we end up taking out the Asian liquidity? Well, yeah, we do with this candle here, which is a news event. We do end up taking it out. But in terms of the London session, we don't. So sometimes you're in the middle of range and you got to trade towards liquidity. You got to see what's kind of nearby, and that's where this model won't work out. So that's so far one day that's kind of worked out. This day we're just trading towards that buy side liquidity. And again, how do you take advantage of this? Well, you've got this inversion fair value gap, right? And you can see how we respect that, we push up, and that could be an entry here to take out this low resistance liquidity. And then eventually take out the Asian buy side. Now, the thing is, guys, once you take out Asian buy side, you don't have a reaction to the downside. So for me, that means, okay, we probably want to go higher. And what do I mean by higher? Liquidity that rests above, right? That's where we want to go. So if you don't immediately react from taking out liquidity, you're probably going to go higher. And that's exactly what's happened here once we take out this, right? So that was Friday's session. Let's now go back to Thursday's session, and we'll do the same kind of thing. We'll map out the Asian session liquidity. Let's just say we started around 7 o'clock. And again, if it's 1-2 minutes before or after, it's not going to make a massive difference, guys. We're just looking at the rough time points to get an idea of where the liquidity is. So there you go. That's roughly 12. There you go. Alright, so that's your Asian session range. Let's map that out again. In this case, if you wait for one side of the range to get taken, which is right here, this will work out again. Asian sell side gets taken. When does it get taken? During silver bullet. You've got your inversion fair value gap here, right, which gets created. You get an inversion fair value gap there that gets created. You've also got this up close candle, right, which is a breaker block, as we know. So it's your breaker block, right, and then inside that breaker block, you also raid liquidity. So your entry could have come as a turtle soup after raiding this liquidity, or it could have come from an inversion fair value gap being created here with your stop below this order block. That there technically forms a balanced price range, but this would have been your best effort here once you see a reaction, because then you can see how price moves. We've got relative equal highs here to target, and then you also target the extreme point of this range. So in this case, we target the extreme point of the range, and we actually extend a little bit further. So that actually works out on the Thursday too. So there's a few days here where it actually kind of works in all aspects. So that's quite interesting too. So now we're going back to Wednesday. We're going back to Wednesday. All right, so just gonna have a look. And again, when the Asian range is trending, sometimes it can be a little bit tricky, right? A little bit tricky. So if we go now to Asian range and we go like say 7 o'clock, say roughly 7 o'clock is here, and then you go to 12 o'clock. So let's go 12 o'clock. Notice the range here is like quite large. Like we're actually ranging in one direction. It's a bit different, right? It's a bit different. So if you have a look at that, we're actually ranging. That's your Asian session range. So what actually happens here is this. If we have a look, we do technically take out the low here of the Asian session range, right? But when do we take it out? We don't take it out in any key time frame. So really, when we're looking at the markets, which is probably at about 2 o'clock, which is here, you want to see a reaction straight away off the Asian session range in a key time zone. And what I mean by key time zone is between 2 to 5. If it happens after 2 or before 2, for example, here before 2, then I'm just looking at what else is on this side of the curve on a higher time frame. Are there any imbalances here that we could target? You know what I mean? So in this case, it doesn't apply because we've taken out the range a little bit early, and I'd prefer to use this model, like for an easy model, to actually take out that range during 2 to 5 a.m. Right? Because as you can see, if you try to go long, you're going to get absolutely wrecked as the market just continues lower. So that there's Wednesday session. If you did take a long from here, right, obviously it would have been stopped out, and it would have been quite evident that we're going to head a bit lower on that trade there. So that there was Wednesday's session, I think it was. So that's Monday's. So there you go. Let's go back actually one more day. We missed a day, I think. Yeah, here we go. We missed a couple of days. Here's Tuesdays. So we'll get Tuesdays. I'll have a little bit of a look at the range. So let's go from, roughly 7 o'clock, which is here, all the way until 12, and then we'll map that out nicely. Okay, cool. That's the range. And if you have a look at what price does, in this case, again, when we're in the key time zone, guys, we're in between the middle of the Asian range. So in this case, it doesn't apply the actual model, but what you've got here, you've got two relative equal highs, the equal highs of the drawn liquidity. So when you're in the middle of the range, you got to have a think about what is more of a draw liquidity. And in this case, relative equal highs, more draw liquidity. And you can see how we trade through that. When we take out the Asian buy side, do we react straight away to the downside? No. Therefore, you've got to look at other liquidity targets on a higher time frame that rest on the left side of the curve. So that's how I kind of approach the Asian session model. So we've done Wednesdays, we've done Tuesdays, we've done Mondays here, right? And you can see how price behaves in different segments. So really, there's at least 3 days there so far, I believe, that have actually done the Asian session model, which is really nice to see. Let's have a look. So let's get the Asian model up now. So let's have a look. 7 o'clock, all the way till 12, right? All the way till 12, which is roughly maybe somewhere out here. We look at the high, we look at the low. Similar thing, guys, similar thing here. If you're in the middle of the range at a key time frame, you got to think about what is more of a drawn liquidity. And at this point, we've got all these highs that are waiting to be taken, right? That's forming trendline liquidity. So in this point, you're trading towards the buy side liquidity, right? Both buy side and sell side has liquidity, but once we take our buy side, then we can move down to sell side. So in this case, once you take out the Asian buy side, which is this point here, do we have any entry models here to go short? We don't. There's no entry to go short here. Even here, there's no entry to go short. So in that case, again, you go to the left hand of the chart and you see what else could be taken, and you can see what happens, right? Once we take out this high, then we have a reaction down. Then we have an inversion fair value gap. So you can use the Asian range or the Asian model in a variety of ways, but the easy model is waiting for the Asian buy side or sell side to be taken, and then looking for an entry pattern that actually goes based on that, right? Based on that. So we'll do this again on the previous Friday. So this is back testing. So we'll go 7 to roughly about 12. Let's have a look. And it applies in multiple ways, so we'll explain that in a second. Okay, that's the range there. Now we take out the range early. In that case, we've got to wait, right? But look what happens. We come down, we come down, we come down. And then once we take out the Asian sell side, or if you class this as your sell side here, then you can look for an entry pattern. You take out this sell side, then you can look for an entry pattern. You take out the buy side, then you can look for an entry pattern. But notice how when you take out the buy side here, you don't have any entry patterns to go short. 2 o'clock is like right here, right? So you'd be looking for a short based on other liquidity points. But once you take out this liquidity and you take out these other swing lows, right, you can see how the bodies and the candles react. We then react to the upside, and then what happens, we actually take out the buy side liquidity. So depending on where you are in the range, like for example here, we've already extended past the range. So if you're past the Asian session range, again, you're looking at liquidity points on the left-hand side. If not, if there's nothing directly there, you're looking at key time frames like macros, 10 minutes before, 10 minutes after every single session, every single hour, and you're looking to see how price behaves there in these macros. And if you don't see anything in a macro, in this case, that's a macro there, that's when we start to sell off, right? Then don't take the trade, right? And then once you see the opposing liquidity, like the Asian sell side be taken, then keep your eyes peeled for an opportunity to go long, right? In this case, there was an opportunity to go long from here, inversion fair value gap here, bullish gap here, and you can see we just progressively move to the upside on that particular day. So using the Asian session range can be interesting. It can be tricky, but you got to see where you are in the range, right? You got to see where you are in the range. It's really, really important. So here's another example. and we'll just go back to this particular day. So again, we're going to map out the Asian session liquidity. Where are we? 7 o'clock. We'll say roughly here, right? And then we'll go to 12 o'clock, which say is roughly there. So we've got swing high and a swing low. That's your Asian buy side, Asian sell side. Notice here when we actually enter 2 o'clock, we're kind of in the middle of the range. So we got to think about what's more relevant to us. It's probably all this trend line liquidity. That's what's more relevant at this point, right? That's why we sell off. And then once we take out the Asian session liquidity, which is this one here, I've got to look to see if there's anything just beside it that might be important. And you can see there, that's what's important. But this is how you use it as a tool, right? Sometimes you're going to get the easy setups where it takes out the Asian liquidity and then automatically reverses. Other times, you got to watch how price reacts, because look at this reaction here. We take that out on this candle, but we don't stop, right? That whole minute candle continues. Then we stop. So as soon as you get to a liquidity point and the market kind of stops or halts, that's your opportunity potentially to look for longs in this case. And then in this case, we do end up taking out the Asian buy side extremes. So you can see how the market kind of works from sell side all the way to buy side. So something quite interesting there. Let's go back to the next day, which is here. Now, sometimes Asian session will be quite like rangy. Other times it'll move quite a bit, right? So it just depends. So let's just say that is 7, and let's say 12 is like here. This is a very like easy example of how to use the Asian session liquidity model, because if you look in that range, you've got a swing low here. This is like a really, really easy example. Swing low there. Once you take that out, have a look at the reaction. You take that out of that candle, we accumulate a little bit, and then we use this fair value gap here. So it depends on your rules too, guys. If you don't want to enter trades before 2 o'clock, you don't have to, right? In that case, you might have to take advantage of something here as a trend continuation, because after seeing Asian liquidity being taken, you know now that, okay, potentially this buy side and these buy side points are going to be taken too. This model works best when it's a range for Asian session, and you can see here it works. We take our Asian sell side, then we use this bullish gap to pump up, right? And this happens early. This happens early, by the way, similar to one of the examples I showed you before. And then we just keep using bullish gaps to then, push price to the upside. So as you can see here, these bullish gaps, they push price to the upside, and we just continue. So you could go long here, you could go long here, maybe during the macro you go long, and then after that, we just accelerate to the upside. So quite interesting. That was obviously Tuesday, 27th of Feb. Now I'm doing this quite quickly. But it kind of just shows you the process, guys. It shows you the process, okay? So if you have a bit of a look, let's go here now. 7 o'clock, where are we? Roughly 7. We'll say roughly there's 7, and then 12 o'clock, let's just say, is roughly about here, right? Now in that range, that's we'll call that the buy side and that the sell side there. So these are our range points. So that's our range there. Now when the market trades, when we want to trade, it's roughly about here at 2 o'clock. Now here's the thing, guys. All these lows, these are still Asian sell side points. They're still Asian sell side points. They're not the extreme points, but they're still Asian sell side points. This is the extreme point, right? Now what I'd be doing in this case, if price comes down here, right, it takes out this liquidity. There's a bit of a shift up. Price comes back down again, and it fails to take out this swing low. It actually forms higher lows. I'll then be curious as to if we're even going to take out the extreme point. So the model can be applied in multiple ways based on your trading style. The best way that it applies is when the Asian session's in a range and you take out the extreme Asian sell side or buy side and you target the opposing one. But when the Asian session isn't necessarily in a big range, because you still move quite a bit here, you're still moving quite a bit. In some of these cases, guys, you might take out some of the Asian sell side and then reverse. And this, you just got to watch the price action to see what kind of signatures it gives you. But you can see here this bearish fair value gap, that becomes an inversion fair value gap right there, right? Plus you've got the fact that, you're in a key time frame, you're in the London open session. Plus you got a factor in that you got a bullish gap right here, which price is respecting, right? So nothing is really saying at this point that we want to go down to take out this level of sell side liquidity, because if we were going to, we should have gone down lower, swept this low, and then taken it out. So sometimes Asian sell side models will actually have this format where you'll be expecting it. You'll be expecting it to actually come back down and take out this, but it won't. And so you've got to adapt to the markets. But the similar process applies, guys. You still take out some Asian sell side. You look for an entry pattern that works for you, and you target the opposing liquidity. In this case, completely fine. We take out the Asian buy side, right? So that's kind of how you approach that model. We'll go back a little bit more, guys, a little bit more. So this is a longer video, but it's something that I think is important. So let's have a bit of a look. So let's get the Asian session range, roughly, where are we? Say that's about 7 o'clock till 12. We'll say roughly here, right? So that's your Asian range, give or take, right? Give or take. Now again, remember I said, guys, if there's like a low or high nearby, you probably want to include that too, right? So this is our range. Technically, obviously there's a high here too, but we've taken both highs out already before you want to start trading, which is probably at like 2 o'clock for most people. Not all, but most, right? You got to think, okay, well, we've, taken out the Asian liquidity on the buy side. What probably could be next? The Asian sell side. And in this case, you could trade towards the Asian sell side if you wanted to, right? If you wanted to. So you could look for opportunities to go short, maybe out of this fair value gap, whatever kind of works for you to take out this liquidity. If that's what your bias was on the particular day, you could do that. Obviously, you've got all this trend line liquidity, but let's say you don't, right? Let's say you don't. Let's say you go, nah, I don't want to trade towards liquidity. I want to wait till liquidity is taken. Well, here's the thing, right? You take out this swing low, you may go for a long here. Look at this. You may go for a long out of this inversion fair value gap. Now, based on your models, right, if you go for a long here, stop loss, because there's only one PD right here, would have to go below the body or the wick, right, of the candle that created the inversion. You're still going to get your 1 to 2. If you're trying to go for home runs all the time, you might not get that. You may get one partial. Now, you might be like, well, why would you take a partial here anyway? Because you've actually got this order block. So you got to keep in mind, like, if you're wrong, because you can't always be right, if you're wrong, order blocks are places that act as resistance. Up close candles should act as resistance. So if you got stopped out here, then you'd have to wait a little bit more and then look slightly to the left here for other liquidity. And you can see now, once we take out this liquidity point, then we get the reaction that we want. So the model still works. It's still going to yield you some, some good risk to reward depending on what you're trading. And if not, if you get stopped out or if you get stopped to break even on this trade, you then just wait for the next external point of liquidity. So this model is something that can be adapted based on your trading style. That would be more of a small scalp. I know some people like to hold trades. Personally, my style is partial. So at least there would have been a partial at this order block. And then if it's break even after that, it's just what it is, right? So we'll do a few more days here, guys, a few more days. I think it's important to see the process and how it kind of reacts sometimes, you know what I mean? Because sometimes it's not going to be perfect. Like, for example, look at this. Look at how big of a range we have. These are the days where the model doesn't work that well. So if you have a bit of a look at this. Let's just say 7 o'clock is here. Look at the range. Look at the range. It's massive. The range is just massive. Too big of a range. I prefer when it's tight and narrow, right? So again, if you look here now, this is back to the example I kind of mentioned before. We've obviously shown that we're pretty bullish. Right? We come back down, we actually sweep some of this liquidity just. We might have created equal lows. Are these high probability conditions? No. But what gives it away here that we're going to go higher is this abrupt down move. That there's called a Judas swing. It's a fake move. And then price obviously rallies up. So large range days, guys. Large range days are not what I want to see. Like, yes, you do take out liquidity here. But again, we're looking at time frames. Where's 2 o'clock? 2 o'clock's like over here. We're already outside of the range. We're outside of the range. Like, so you're not really seeing too much here that's important to me that I want to take advantage of a trade on. Let's have a look back here. Let's go here somewhere. And let's mark out the Asian range. Let's go, where is it? 7, we'll say roughly there. 7 till maybe 12. We'll call it that, right? Give or take, right? It's rough estimates, but it doesn't, again, matter too much. So again, this is a decent example. We take out the Asian buy side. This is like the A+ example. We take out the Asian buy side. You're in a key time zone, like you're in silver bullet or something like that, and then you've got an entry model to go short, right? The other examples are tricky examples of how to actually navigate it when it doesn't exactly go your way. There's your civvy. That's a little breaker. You can see how we accumulate there and then we sell off. There's all this liquidity to target. So you can't just trade based solely on this model. It's good to have liquidity to target too, because again, the market only moves for two things, liquidity or imbalances. And you can see there in this case, we do take out that. When does that happen? During silver bullet, right? So this model will repeat. The easy way to do it will repeat. The trickier versions will also repeat. It's a matter of how you, how you navigate the markets. Because have a look, example, in this case, right? Have a look at this case. We range quite a bit from 7, if you go all the way to 12. Right, look at that. We range quite a bit. That's quite a large range. Price comes up here, right? This is the Asian buy side, Asian sell side. We're in the middle of the range. So the middle of the range, maybe there's an imbalance here. That we're targeting, but it's not really the model of taking out liquidity. So in this case, you then have to go, okay, we're in the middle of the range. We're in an imbalance here, break a block here. What do I want to target? What has the Asian range kind of told me? Well, there's relative equal lows here. So if you wanted to, then you could target these, equal lows from this inversion. Have a look at this. You got a bearish fair value gap here that exists, right? And then you've also got this inversion and this bearish fair value gap here. Again, you've got trend line liquidity, you've got clear targets. That's really important, and you've got equal lows. You can see how we smack through that. So again, once you take out that Asian sell side, then you can start looking for buys potentially, right? If there's a setup. That's the important thing. If there's a setup, so you take that out, you're still within silver bullet, you start to see price kind of move up, you see this start being respected, you might take a long from this bullish gap, you might also take a riskier play depending on your risk tolerance. As we reject here, change in the state of delivery once you come above this candle, and again we return to this bullish gap, so you might have taken a trade here, small contracts, maybe entered in again here, and yeah, you might have been aiming for the top of the buy side, but this is why partials pay, and it's really, really important. Because then you can see like we go down for the rest of the session until later on, and then we take out some buy side. So hopefully this explains the process to you guys. That's quite a few weeks, I guess, of back testing this Asian session model. There's different ways to apply it, as I've kind of mentioned here, which is an important thing. And I've shown you some of the easy ways and some of the harder ways that you can apply the Asian range and the Asian session model. So this is kind of an in-depth video. Let me know if you guys enjoy it, and until next time, I'll talk to you guys then.